Investment meeting for July 2011. With that, Commissioner.
Good morning, everybody. Let's go around. I'm Andy Schaefer, representing Commissioner Kelly.
Joe Alejandro, PBA.
Chris McGrath, PBA.
Bob Ganley, SBA.
Tom Sullivan, Housing. Chris Mahan, Seagate.
Michael Powell. No, DEA.
Bob North, Actuary.
Barry Dennis, SAS.
Irish Loss Controller's Office.
Danny T, Controller's Office. Mark G.F., Controller's Office.
Stephen Browning, Controller's Office.
Jana Marine and Finance.
Karen Seaman, Law Department.
Bob Sensky, State Pension Fund. Kevin Holleran, Pension Fund.
Sleep Wilson, Controller's Office.
Karen Miller, Controller's Office.
Yvonne Nelson, Controller's Office.
Leon Dunham, Controller's Office.
Okay, everyone, welcome to the public session. And with that, let me turn it over to the Controller's Office, Larry Schloss.
Thank you. I think today's session should last 3.5 hours. We do the right. We do it not to start conversation or anything, but manage expectations. So everybody should have their monthly reporting package for May. I would tell you that since May was followed by June, which was the end of the fiscal year, we could do this pretty quickly. The key charts in here really are page 2, which shows you GDP declining, and the general consensus now is sort of down from 3 to 3.5 to around 2.5% growth for the economy. You can see on page 4, manufacturing index is going down. That's partly what's driving it. 5, you can see unemployment's not going down. In fact, on 6, it's going up. The most troubling page is page 8, which is architectural billings, which I've said in the past is sort of a leading indicator of capital expenditures and corporate spending, which is cancelable. So the fact that it's going down is not good. In fact, it went below 50, which is also not good. Page 10, you can see housing starts continue to be in the doldrums as well. And on 12, auto sales are declining. So overall, the economy is slowing. The Fed's not quite slowing. And my guess is we just have this pause for the next 3, 4, 5 months. If you go to the markets, the key drivers of the markets were what's going on with Greece and the euro, which is a complete mess. In June, the Fed ended QE2, is stepping to the sidelines, and currently in Washington, we've got the U.S. debt ceiling problem and the budget negotiations. All of that led to, I guess if you look at page 16, the dollar, a lot of volatility on the very far right-hand side. Again, that was people coming in and out of the euros, safety in the dollar. The safety in the dollar was really manifested in page 20. Page 20, the white line is the yield curve. And as you can see, from December, which is the orange line, to the white line, it's just continued to come down. If you look at the very short end of it, the let's call it 3 months to 1 year completely collapsed because everybody rushed into the short end, and you can see it up out to the 2-year mark. And if you go back one page to 19, you can see again in June-ish a lot of volatility in the VIX. People were just perpetually anxious until the last week of June when the stock market rose about 4% because Greece passed their austerity plans. It's manifested itself on page 24 with the stock market multiples. The stocks are looking kind of cheap, actually, on a projected earnings basis. So the good news is stocks are cheap. The bad news is the economies are slowing down, so people aren't quite sure what to do. You can see this evident on page 26, which again is the markets kind of gravitating down. But again, if you look all the way at the end of page 26 on the right side, it then picked up the last week of June. If you jump to page 28, over to the police asset values, which is the most important thing. May was down just a little bit from June. April. April was an all-time high north of $25 billion. We're down at 24.9. My guess is we could probably come off that a little bit, but I'd have to guess. I'd say we're going to be between 24.5 and 25 billion at the end of the fiscal year, which is in the bank. We just have to count it up now. So that's sort of the range, 24.5 to 25, I'd say. If you look at page 29, you can see how we've done for the year. Quite frankly, awesome. It's up in excess of 20, and again, we're getting the manager reports now for June, so we'll know exactly how we stand by the next time we get together. On page 30, you can see the asset allocation. In general, we're leaning long into equities and not so long, and less in allocation into fixed income. It's served us very, very well. We've sold, since this May report into June, we sold 2% of our stocks. We're trying to de-risk the portfolio. We also lightened up a little bit on high yield, all of which I think was good. We were trying to protect the gains that we had through May and not give it all back in June, and I think that worked very well. So if you look on page 31, if you look at the cash number, we had 3.6% cash coming into May, so we probably have in excess of 5% cash at the close of the fiscal year, and we're going to redeploy the cash during the summer. As you know, we have to fund the opportunistic fixed income. Hedge funds are going to get funded. There's some private equity drawdowns and such coming our way, so it should slowly start to take care of itself. In addition, we have the new asset allocation that we're going to talk about, and that's got some funding requirements in the future as well. So the cash will come back down as we go back into a little more risky mode. Page 32. This is the May. Again, this is before the volatility of June. May, it showed the benefits of diversification. We lost money in equities and made money in private equity and fixed income. So net the month we were down 0.5%, but the key number is fiscal year to date, so it's 11 months. In the bank was 24.65%. Again, great showing. I'm very confident we'll be north of 20, despite the volatility in June. I just can't quite tell you the right number. With that, there really wasn't that much to talk about on an individual manager basis. You can see, again, the greens and the reds as to who's doing better and who's not doing better. I think we'd like to spend more time on the individual managers next meeting, because then we'll have the full year to talk about, and it will incorporate the volatility of the month of June. So that basically concludes the review of the monthly performance, unless anyone has any questions. Okay? All good. With that, let me hand it over to Barry Dennis. As you know, we spent the better part of 9 months on our asset allocation work. Barry has the final product. We feel very good about it. And let me just hand it over to Barry. We have one corrected page that has some typos in it.
I'll explain what those typos are when I get to page 10.
So we're in the book now, right?
Yes.
Yes. Hang on, what page are we on in the book? 4, I think.
Let's see. Like 56 to me.
56?
Well, I don't know. Something like 56.
56 in your prayer book.
Okay. This is an ongoing process that we've been working on for probably 15 months now. We reported to the board in February with some preliminary results, and since then have had meetings with the Bureau of Asset Management to crystallize what we're trying to accomplish and to fine-tune the ultimate recommendations going forward. On page 56, these are the goals we're trying to accomplish by revisions of the current asset allocation target. Most of all, to just broaden out the diversification with the hopes that we can reduce the overall volatility of the fund. The second is that, as we've talked to you many times, the current policy has a lot of its risk exposure, and we measure that as about 92.5% exposed to the vagaries of the equity market. And we need to get that down so we don't get whipsawed as the market goes up and down. Third is to make the best use we can out of the current and perhaps future limits on basket-eligible assets. Importantly, we've made selections for hedge funds and opportunistic fixed income allocations, and we need to create space in the policy targets to fund those two areas up. We are trying to begin building inflation hedging assets right now and maybe for the next 12 to 18 months looking forward. Inflation doesn't appear to be a problem, but someday this is all going to come home to roost. The budget deficits, the potential decline in the dollar, especially relative to emerging market currencies. So we want to start getting the vehicles in place to put an inflation hedge in our portfolio. And as we'll see, the new targets have more allocated to what could be called illiquid assets, assets that you can't cash out tomorrow. It may take a month, may take a year, may take longer. We need to set up a system to monitor the level of those exposures. And we want to do all those things, but we don't want to sacrifice return. That's, in the nutshell, is the problem we're trying to solve. So the next page just reviews what we've done so far. We've looked at potential adjustments in February. We've established the initial hedge fund and fixed income opportunity managers and need a place to put them when they get funded. We've introduced the concept of having 3 buckets defined by functions in the economy rather than asset classes. And we've looked at risk allocations in addition to capital allocations. Today, what we'd like to do is to set up for your approval a policy target, but not just one, but 2. One under the current statute that allows only 25% in the basket, but in the instance that we would get what I'd call basket relief, up to 35%, to have a policy ready to go under that scenario. And then the other thing that we're going to present today that's new is rather than just having a single forecast with a base return and a standard deviation set around it, to look at various economic scenarios. And these are all what I'd call bad scenarios, not really good, especially for the stock market, to see how these new allocations would have performed under historical stressful periods. On page 4, just to review how we've come up with our estimates for risk and return and correlation. I've gone over this with you many times, so I'll just hit the highlights here. We redid these numbers in November, and they're still good numbers. We saw a little spike up in bond yields in the spring. Now they're right back where they were in November. So we're still confident with the November assumptions. These are long-term assumptions. We say 2 to 3 market cycles. That probably translates into 10 to 15 years. And then the 5th point is the process that we've followed at SIS since our founding in 1994. So that's 17 years. We do it twice a year, so that's 34 iterations. And we try to stay within long-term real return corridors, that's the return over inflation historically, over 3 and 5 year holding periods. And then we mean revert. So something that has done very well over that period, the recent period, gets downgraded. Something that has done very poorly gets upgraded. But we never go beyond the corridor that's established by the long-term 3 to 5 year rolling real return numbers. On page 5, just sort of asset class by asset class. Again, I'll just hit the highlights here. Fixed income, we think the bond market is a pretty smart animal. So we accept the current yield to maturity, or specifically yield to worst, on the bond market as the forward-looking return.
I can also tell you that we've done some analysis of this going back 20 years, and because in the investment-grade fixed income universe there are only a handful of defaults, the yield to maturity is a very good indicator of your expected return looking at the average life of the portfolio. So it is historically been very accurate.
Thank you. We've looked at the same thing. And then we adjust it for your Core Plus 5 target. So what we're doing is actually removing 1 to 5 year government securities from the broad aggregate index. And that has the effect of actually raising the expected return on your portfolio. Because I'll tell you, the government has issued a lot of 1 to 5 year debt over the last 3 years. And it's been issued at very low coupons. For inflation, we're using a combination of a survey of 53 economists, 10-year forecast, and what the TIPS market relative to the nominal bond market is telling us in terms of what the expected future inflation rate is going to be. For large cap U.S., we're using a dividend discount model. So we make estimates on GDP growth, dividends, and inflation. And it's actually the dividend yield on the current market that gives us our mean reversion quality. So when yields are high, that means prices are low and expected returns are higher because we're plugging a higher dividend rate into the model. When yields are low, our expected return is lower because prices are high, they've done well, and dividends, you don't have the dividend cushion going forward. And we do the same thing for international, but we do it country by country. So in IFA, we're looking at 24 different countries' dividend discount models, and with the emerging markets, we're looking at each individual market individually and aggregating them. For absolute return, we think you could earn 4.5% over cash rates, which today are close to zero. And we think that hedge fund managers can have a higher risk-return relationship than long-only managers because they have a broader opportunity space in which to operate. And then commodities, we use the Goldman Sachs index relative to inflation. And right now that market is in contango. It's a futures market. So the futures prices are well above the spot prices, which means you have a negative roll yield. When you roll your contract, you lose money. So the returns on commodities are lower than they historically have been. And then fixed income opportunity, we use a combination of 3 different bond indexes, high yield, emerging debt, leveraged loans, and it comes out about 3% higher return than Core Plus 5. Those are consistent with the yield premiums we're seeing in those markets today. On page 6 are the assumptions we're using. Again, a lot of numbers here. I'll focus first on one pair of numbers. And this is consistent with what Larry just said. So the U.S. large cap stock return expectation is 8.1. You see U.S. fixed income at 3.8. That's your Core Plus 5 estimate. If we were just using the aggregate index, so putting those 1 to 5 year treasuries back in, the estimate is 3.2. So you have two numbers, 8.1, 3.2, the return on stocks, the return on bonds. If I subtract the latter from the former, I get 4.9%. That's called the risk premium of investing in equities, the expected return over bonds. That equals 4.9% today. That's a big risk premium. It's suggesting you will be paid handsomely for investing in equities. Typically, that number is close to 3%. So we're at like a 60 to 65% premium over history with our current expectations. And it's not because we're super bullish about the stock market. It's because yields on the bond market are so low. They're at historical lows. So I'm the first to tell you, this is not a normal set of expectations. And I'll come back to that at the end of the presentation. We can skip over the correlations unless there's any questions about them. These are just what the model tells us they are, looking at history. On page 8, we get into how this thing called an optimizer works. An optimizer is a naive equation. It looks at our inputs on risk, return, and correlation. It doesn't know anything about liquidity or transaction costs, things like that. So there is some judgment put into these numbers. I explained that we're using a full history with mean reversion. On the output, 2 points. Number one, there are some asset classes that you don't want the computer to pick for you. And I would point primarily to hedge funds. Hedge funds are not an asset class. They're an aggregation of asset classes that are dependent on skillful management to achieve the return. So if we just plugged in our assumptions that we have for the hedge funds, I'm telling you the optimizer would put half of your portfolio into hedge funds. But from a liquidity perspective, or from a potential question of the veracity of the historical data, that's not a good idea. So we just specify the hedge fund allocation. And in this case, we used 5%. And then we create an efficient frontier, getting the most bang for our buck, the highest return at a given level of risk. Page 9 outlines how we're grouping the assets. This is important when we look at the risk allocations a little bit later. Under growth, these are assets that are going to fund your real liability growth and make up for any unfunded status that you might have today. And they're primarily equity asset classes and the dicey part of real estate, the opportunistic. Then we have the yellow bucket, which are diversifying assets. These tend to be lower return assets, but uncorrelated with the rest of your portfolio. They include bonds, opportunistic fixed income, high yield, and the hedge funds. And then we have a bucket for inflation hedging assets. And in that bucket, we put TIPS, commodities, and your core real estate. Now, one could argue that some of these asset classes may cross the borders of these circles, but for this purpose, we're putting the whole allocation into a single bucket. Okay, page 10 is where the real fund begins. Just as the extra handout, let me explain the differences. In your books, it says 39 and 15. The right numbers are 38 and 16. We modeled it correctly. These were just transposition typos. And then the other changes, your page says 22.5 in Core Plus 5, and the handout says 21. Your page also says 0 in Opportunistic Fixed, and the corrected page says 1.5. We were modeling 1.5. So the 1.5 was added to the Core Plus 521 to get to 22.5. We are simply modeling opportunistic as 5% of the Core Plus 5 allocation. So this is just a cosmetic correction. And then for purposes of simplicity, we put the convertibles into the high yield. We don't think you should have any asset class targets that are in the level of 1%. Asset classes should have bigger, meaningful allocations, and those two asset classes have very similar risk-return expectations, so we just lumped them. In the corrected handout, we break them back out. Now, if you look at point number 1, the illiquid portion of these allocations, what you're seeing is that today we classify about 12% of the portfolio as illiquid. This goes up to 23% in a 25% basket scenario and 25.5%. So the illiquid portion is growing. And at some point down the line, we should have a policy about how big that should get, how much liquidity we need to facilitate rebalancing and the payment of benefits. Then you see the basket allocations right underneath that. 21.5 currently. Under the 25% basket, we get up to 23%. We really have to leave a little bit of cushion in there because some of these asset classes we can't rebalance out of. And then under the 35% basket, we get up to about 31. And again, in that scenario, we have to leave a little bit bigger cushion. Now let's look at the expected returns and expected standard deviations. These are expectations using our assumptions. So the current portfolio is at a 7.81 return and a 12.9 risk. If we look at the 25% basket allocation, we maintain the same level of return, but we reduce the risk, the standard deviation, by 40 basis points. Then in the 35% basket scenario, we pick up the expected return by 12 basis points, but we only add 20 basis points of risk. So those are efficient additions to risk and return by going to 35%. And when we're at 35%, we've got a higher return and a lower risk. That is the magic or the free lunch of diversification. Then we backtest through various stressful periods in the equity markets. We look at the crash of 1987, the long-term capital management crash, the attacks of 9/11, the tech bubble correction, and the meltdown we recently experienced starting in 2008. And just looking at those numbers, comparing 25 to the current, comparing 35 to the current, and comparing 35 to 25, you reach the conclusion, and it's almost 100% consistent, that each of these steps is an improvement over where we are, and 35 is an improvement over 25. The only exception to that is in the period following the attacks of September 1911, or 2001, where the returns stay about the same, negative 7.3 and 35 versus the current. Everything else improves. And where you see tremendous improvement is in the tech bubble contraction back at the start of 2000. You see tremendous improvement. The other improvements I would consider marginal, but in the right direction. Now we move to the risk allocation on the next 3 pages. I can go quickly over this. Under the current policy, page 11, or you know what page I'm on.
65.
65. Thank you, Larry. 92.5% of our risk is allocated to the growth assets, basically the equity assets and the opportunistic, and only 5% to diversifying and 2.5% in the inflation bucket. So we're overly dependent on the equity market. On the next page, we look at the 25% basket scenario. We bring that 92.5 down to 85.1, substantial reduction. And most of the increase is going into diversifying, but we are doubling our inflation sensitivity risk allocation. Under the 35% basket, we make another major step to 79.1 to growth, 12.5 diversifying, and the inflation goes up to 7.6. At some point, we'd like to get even more broadly distributed amongst those 3 baskets.
Is it 79.1 or 79.9?
79.9. But given the basket constraints and the need to achieve something in the high sevens, that's not possible at this point. This is as good as we can do.
And just as a footnote to what Barry's saying, you recall that hopefully in the next legislative session, we're going to go up to Albany and see if we can get the basket moved from 25 to 35 so that we can get here quicker. But right now, we're kind of constrained with the 25% basket. I think we'll get to the edge of that probably end of next fiscal year or the beginning of the next. It's doing our normal working our way into this asset allocation. So it's very important that we all work together. Thad's going to lead this effort for the Comptroller's Office next legislative session to get this 25 moved to 35 because it's going to get in our way.
That's my understanding that the state control town monopoly has an interest also in raising past proposals that past conferences and what's that?
We've had some initial conversations with his office, yes, Joe, and also state teachers.
State teachers. This will be talked about.
Yes.
Next, what we're going to do is take a look at some economic scenarios. All of them not good for the markets. And there are 4 of them. One is a high inflation scenario, similar to what we saw in the late 70s and early 80s. And then if you look under the column inflation, we give you the return expectations that we've devised using our methodology in those types of environments. So these aren't the exact returns you saw in those periods, but they're put into the context of our process. Now, keep in mind also that these represent 10-year holding periods. So it's not what you get in a 1 year, you'll see in a 1 year period, but in a longer period in that type of environment. That subdues the returns to some degree, either good or bad. In inflation, high inflation period like the 70s, now that's going to be good for the inflation-sensitive assets, obviously. So real estate and tips do very well in that type of environment. It's also pretty darn good for non-U.S. stocks because part of what causes inflation in the U.S. is a weak dollar, strong foreign currencies, and the cost of our imports goes up. So that works pretty good for international. It hurts stock returns, and bond returns are okay. I mean, they will go down when the interest rates go up, but if you have a 10-year holding period, you're going to be collecting a higher coupon throughout that 10-year period, which will eventually give you a higher 10-year return than you would if rates hadn't moved relative to today. The second period is deflation. We've really had no extended period of deflation in the United States, so these are hypothetical. If you don't like them, blame John Mayer. He came up with them. Deflation is very good for bonds, especially relative to the other classes, but bad for just about everything else. Then you have recession. This is similar to what we saw in the 70s in the United States, the recession of the 70s. It's real bad for equities. You can see the returns go negative to negative 5.7. And that's across all the equity asset classes. It's okay for bonds, and it's not deadly for real estate. The low return scenario is what you read about Bill Gross talking about new normal. And all that means is returns are lower across the board. So we've reduced everything by about 1 to 2%. In all these scenarios, the risks remain the same. On page 15, we give you how the portfolio should perform over a 10-year holding period under if those 4 conditions would stay in place for an extended period of time. We're just showing you the returns because the risks, again, haven't changed. We've kept the same risks under all scenarios. And like when we back tested in those unfriendly scenarios on page 10, we're seeing consistent improvement of return with the 25% basket proposal and the 35% basket proposal. The only exception to that is in the middle at the bottom, where the low return, the new normal scenario, has a slightly lower return than the current portfolio. Everywhere else, we're seeing slight improvement in the scenario analysis. So let me get to our conclusions. I laid out the strategic objectives at the beginning. These proposals move us toward meeting those objectives. Probably not as far as you, Bureau of Asset Management, or I would like to go, but we have constraints. So they're small improvements, but they're consistent improvements. Point 2 is these proposals provide consistent, better results in adverse scenarios, both back-tested, prospective, and scenario-oriented. Number 3, it gets us in a place where we can start building these allocations to hedge funds and fixed income opportunity. And I'll be the first to say that there's more work to be done. I think I would talk about 3 specific areas. Number 1, we're talking about basket relief to 35%. The ideal outcome from those negotiations would be some sort of prudent expert standard and do away with any basket at all. Just your requirement to act as prudent experts would in a similar situation. Then all bets are off. We can go a lot of different places if that type of legislation is granted. Number 2, I talked about this not being a normal environment. Equity risk premiums way high relative to history. If we get back into a scenario where bond yields are higher than equity, the inverse of the equity PE ratio, or what they call the earnings yield, and that's the way things are supposed to be, we could be suggesting higher allocations to core fixed income in general. But we're not there. We will get there at some point, but I can't see it in the future. And the other thing we really have to work on, given the higher allocations to illiquid assets, is new rebalancing policies. And that is on the table to be worked on over the next couple of months. Yes, Janice?
Should we also be thinking about where we invest our cash that's being set aside to invest in private equity and real estate? I think currently now our policy is to invest that in equities. And should we be thinking about that from a risk perspective?
Well, one of the things that we're in the process of doing an inventory of all the IPSs, and those are things that pop up right away in the redone IPSs, and we're going to wheel those around in the fall.
But yes, I think we should be establish, let's call them parking places, that have the risk-return profile of the assets they're intended to fund. And the bad news about doing it that way is it's a lot more expensive because you pay higher management fees on those parked assets than you would in an index fund. But the good news is you're going to be achieving the risk-return profile that is set out in your objective.
Barry, for the record, the numbers you presented here, the returns are arithmetic or geometric returns?
Geometric.
And net or gross of expenses?
They are assuming index performance. Okay, so there's no fee attached to them.
Could you clarify with respect to things like private equity, where passive management isn't really an option?
For private equity, we are using a post-venture series, so private companies that have gone public. So we actually do have an investable index fund to proxy that asset class. So it's it's based on performance of a post-venture series.
So that would make it net of fees?
Net gross is the same because it's index.
Right. Just his question about gross versus net. It's the only thing that's different than the other asset classes?
No, the other asset classes are all based on historical index performance.
Fair enough. Minimal fees.
Yeah, minimal fees.
Private equity is not so minimal.
Right.
And then finally, on the 25% basket limitation, I think you'd agree that at 24.3, a single day in the market could, if the things were invested exactly as to policy, could trip the legal problem. I presume the 24.3 will come with some comment in the IPS or the asset allocation just to the fact that, one, it's going to take a while to get there, and two, that by which time it may be 35%, but that the IPS and the board is very sensitive that it will not adopt any policy with an intention of in any way violating the legal limit.
That makes sense to me.
Right. That's correct.
Thank you.
In fact, to your last point, if you look on page 78, which I'm desperately trying to find, we're at 7.1. We're only at we have 7% left in the basket, right? So to the extent we get this done in the next legislative session or a little bit thereafter, we got a lot of walk-up room before we get to the 24 or 25, right? We can't really move this portfolio quick enough to get ourselves in trouble, I don't think. So there'll be room.
Right, and
Lots of room.
I assume that is the case, but I do think it's just important that the documents that back up whatever is done be sensitive to the recognition that this was discussed, understood, and there would be no intention ever of putting the system in danger of breaking the legal limit.
Right. So what we need now is a motion to adopt these, unless there's any other questions or discussions you guys want to have.
Let's get the vote. This is 2 minutes.
Okay.
Joe, would you like me?
Yes, Barry. short focus. We would like to make the motion to accept the asset allocation recommendation for SIS up to the, was it the 25% constraints by law, right, currently, with the hope that we'll be able to get it up to 35% in the future, but we are constrained by law, so the motion is to accept the recommendation up to the 25% basket clause constraint.
Do we have a second?
Second.
Any objections? Okay, so moved.
Thank you very much. We'll work hard to put those in and exceed these conservative SIS projections for the asset classes. With that, let me hand this over to Thad.
Thank you. The board members should have in front of them two resolutions. These resolutions have been amended slightly from what's in the book. The amendments circle around the resolve clauses. In conversations with the trustees asked that in both resolutions we bring them back to the board once we have testing for board approval. So to step back for a second to give it a little context, I first want to thank the trustees and the Office of the Executive Director and his team. As you know, working closely with Comptroller Liu, the board has embarked on a number of what some might even consider historic initiatives in terms of promoting transparency and disclosure. For example, we now webcast the meetings. We have an online library for those who are interested in seeing past agendas and board minutes and such. So I want to thank the board for their support, and I think the resolutions before you today continue that trend, and specifically the first resolution that I'll bring up is the what we call a real-time portfolio. This resolution will allow us to post the holdings of the funds online in real time, and the second is including the expenditures of the police pension fund in the controls initiative known as Checkbook NYC. So, as I mentioned earlier, the one difference you have in the resolution, the only difference that you have in the resolution before you is that the resolve clause would require, once we've done our testing and building, that will come to the board for their review. And we do appreciate your support. So I'd be happy to take any questions that the board members may have. Otherwise, I invite a motion to...
I came to this meeting because having seen
Sorry, I
these-
can't hear you,
I came to this meeting because having seen the resolutions last night, from the mayor's side, we agree with the desire to have as open and as transparent a board and its activities as possible. Mayor's always been in favor of that. And we have no objection, not only no objection, we encourage and agree with the resolve clauses of both resolutions. Although I will point out that posting daily valuations of a fund like this, we should make sure that the members are sufficiently educated to recognize that there could be real serious swings on a daily basis that shouldn't get people crazed one way or another, right? You know, they can go up, they can go down. So there's a little bit of danger in posting daily swings with unaudited numbers. But that said, we're fine with that. What I object to in the resolutions is the use of these resolutions to promote political and social agendas. Our job as trustees is a fiduciary one to promote the fund and to earn the best returns we possibly can at acceptable risk levels for its members, not to promote any other agendas. And I find the whereas clauses in both of these resolutions go beyond the line as to what we should be doing as a board. So we have proposed alternative resolutions which simply say, whereas the board is committed to transparency, here's what we think we should do. And they come to exactly the same place. They just strip away any of the political and social statements that I don't think have any place right now before the board. We've sort of been consistent with that, with the issue of the disparagement clause and other things like this, but particularly I find it troublesome here where the board is adopting a resolution and apparently signing on to statements that, whether you agree with or not, I just don't have any place in a resolution like this. So I would urge people to vote against that, and I would urge people to vote for the alternative resolution, which comes to do the exact same thing substantively.
Commissioner, I don't disagree with your first assertion about educating not only the members of this fund, which always is primary in my mind, making sure that the members understand their benefits and what this fund will do for them. But I also agree that putting out unaudited numbers to people with agendas out there, editorial boards, and the like, is also dangerous, because we don't invest on behalf of editorial boards, which somehow they get these stories and they run with them. So I agree with you on that. But I believe that we're a step in the right direction in trying to at least show how this fund performs, and it's performed well. In fact, if we want to put the facts to the fiction out there, the fund has done extremely well and has more money in it now than it's ever had. I'm sure the mayor knows that, even though editorial boards seem to report differently. So I just have one question. Is there any untruth in those whereases that you have a problem with?
Let me go through two of the statements. I think that, as I think you know, Joe, I actually don't agree with you that we've done well. I think that we have had X% returns. I think on a comparative basis, we have not done as well as we should have had, and you know that we've talked about that and where we stand on that. You know, the fact is that, yeah, if you could guarantee that we would have 15 or 20% positive returns for the next 200 years, I would live with that, and that would be fine. Even if
But
I
that
would
would
know
be good enough.
Well, even if I know that the better run funds would have 2 or 3, 100 basis points beyond that, I mean, I could live with it if you can guarantee, but you can't guarantee that. But I mean, you personally, we can't guarantee that. And as you know from other meetings, I think that we need to strive for a much more professionally run investment vehicle here, and we need to do it in different ways. And we started to talk about that, and maybe we'll agree, and maybe we won't. So the fact that the fund has more money than it's ever had before, I just don't think is the right measuring rod. So if we should have 10% more than we currently have, that would be a better measuring rod. And I think that these funds should perform, given where we are, who we are, what city we live in, should perform at the top level of investment returns. And quite frankly, we don't. So, but we've had that discussion. And I find, in answering your other question, I find particularly the second whereas clause to be whether you agree with it or not. And that's just not the kind of thing that belongs. I frankly think that we don't need any of these whereas clauses. And if you look in the alternative resolution, we simply say we want greater transparency, and here's what we're going to do. I'd be happy with no whereas clauses. Just here's what we're going to do. And we don't need to get into a whole debate about these different issues, which I think are not only tangential to what a board should be doing, but are distracting to what a board should be doing. Right? Our goal is to get more transparency, and that's what we should do. And that's the only debate that we should be having about how we should do that, not about all this other extraneous stuff that has no place. That's my view.
We heard if the trustees want to add anything. So I would, Commissioner, take strong exception to your comments that the whereases reflect some political or social agenda. The Comptroller's Office over the years has always had nothing but the highest regard for the fiduciary obligation of the board members at this table, and has always been about investments, and I believe there's nothing inconsistent in these resolutions that suggest a political or social agenda. In fact, I believe they are fact-based. They talk about the recession, which is a reality. They talk about the initiatives that working closely with the Board of Trustees and Inspector Halloran and Inspector Sens-Cassette that this board has adopted so that the members, retirees, beneficiaries, and the general public have a greater understanding of the important work that this board does. So, again, for the record, I would take strong exception to the fact that anyone on this board has a political or social agenda when they come here.
And I would just like to add, Commissioner, I see your points, but I think the second whereas is probably the truest statement on that paper.
So I appreciate that those are the views. What I'm saying is, whether I would agree with that or not, I don't think it has any place in a board resolution, and I think it opens the door to all kinds of other statements that we simply don't need. We're trying to achieve a goal. The resolution clause is the goal we're trying to achieve. It seems to me that's what the board should be saying. Here's what we want to do. And we don't need 700 other reasons for why we might get there that the board may or may not agree on. The board's obligation is to serve as a fiduciary in trying to get these funds to get the best returns at an acceptable risk level. That's all we need to do, and to be as transparent as we can to the public. Right? We have a resolution before us which says we want to be transparent. Here's what we're going to do. It seems to me that's the way to fulfill our obligation.
So with that, unless any of the board members want to be heard, we have two resolutions before you. First I'll take is the Checkbook NYC. If it pleases the board, I will make a motion that we adopt that resolution.
Well, before I vote, I just want to say one thing. If we took out whereases and didn't put down reasons why we're going to accept the final resolution, I think the Declaration of Independence would be stripped down to maybe one sentence. So I'm going to go with the whereases in the spirit of independence this week, and I'm going to go with the resolution as proposed by the Comptroller. I think the whereases speak to a truth. Maybe people can disagree with that. That's fine. But I think overall the resolution will speak for itself to everybody, and I will second that motion. Oh, I'm sorry. You make the motion? You made the motion, I'll second it.
I have the mayor's proxy for this issue. Can we do a roll call vote on this?
I just make it clear that my objection is not, whatever I may personally feel about the substance, it's that this has no place here, right? And that statements like these have no places here. And it wouldn't matter whether I agreed 100% or disagreed 100% with what that statement is. I just don't believe they have any place here.
I think, coming here, kind of, I feel, 4 years on this board, we've acted professionally. We have fiduciary responsibilities. My goal is to keep and maintain benefits for my members. And I'm insulted that you come here and call me unprofessional, is what was said. So, one of opinions, that's my opinion.
And Commissioner, I'm not piling on, so I just want to make sure that there's a vote on the board right now. Everybody's points have been heard. There's a motion on the floor, and we're going to take a roll call vote as per request.
Prior to the vote, just to continue discussion on the motion. With regard to the whereas clauses, it's the policy of this board. I've been sitting here for 3.5 years, and every resolution that we've voted on has always contained whereas clauses, addressing the topic, of the resolution. And to discontinue them today, I disagree with that. I think we should continue that practice to further add light to the resolution that we're voting on.
So there's a motion on the floor.
Motion. Roll call vote? Is
Roll call?
Okay. PBA?
We go with the Comptroller's recommendation, yes.
DEA?
Yes.
SBA?
Yes.
LBA?
Yes.
CEA?
Yes.
Mayor's Office?
No.
PC?
No.
Finance?
No.
And Comptroller?
Yes. And just to follow up, I think that the trustees in this board and our office has acted always with the highest regard for the fiduciary obligation to the members, retirees, and beneficiaries, and will continue to do so.
By the way, I just want to say, this is the process, and I appreciate the process. Everybody can agree or disagree. We accept that. And the vote has been made, and we'll accept the controller's recommendation. And we appreciate the commissioner's comments, and we understand how you feel.
So moved.
Now we're on motion, now we're on resolution 2.
And that's for the real-time portfolio, correct? Motion 2?
Checkbook.
Sorry, checkbook. So on checkbook, again, the only difference between what we've seen previously is the change in the resolve clause, and with that, I'll make the motion to move the resolution to include checkbook NYC, include the police pension fund expenses within checkbook NYC.
I'll second.
Comments on this?
We have the same comments as the others. There's no point in rehashing this all.
And we'll
Okay.
for a roll vote.
Yes, okay, roll call. Okay.
DBA?
We vote yes with the controller.
DEA?
Yes.
SBA?
Yes.
LBA?
Yes.
CEA?
Yes.
Mayor's Office?
No.
PC? No. Finance?
No.
Controller?
Yes.
Okay, so moved.
Done. One last thing I'd like to just review. On page 76, I don't think we reviewed this at the last meeting since these are the main numbers. You can see our performance relative to other public pension funds greater than $10 billion. If you look at the first column on the left on page 76, the system's 4.8% puts us in the 12th percentile. Clearly, banging on the top 10, top decile. And for the 1 year, we're on the 18th percentile. And we pulled our 10-year ranking up to the 52nd percentile. A couple of years ago, we were in the bottom quartile. Now we're banging again on getting into the second quartile for 10-year performance, given the results we've recently achieved.
We can always do better.
We can always do better. But these are pretty damn good, for the record. So with that, that concludes the public agenda, unless anyone has anything else they'd like to talk about.
Just a reminder, there's no August meeting, so we have some matters to be discussed in September. I guess if there's anything in August, if you want to reach out to anybody and prepare, just let us know.
Okay. Thank you.
Okay, do we have a motion to
Motion
exit?
to leave the public session and go into executive.
Second? SBA? Okay.